Unlike fundamental analysis, which attempts to evaluate a security's value based on business results such as sales and earnings, technical analysis focuses on the study of price and volume. Technical analysis tools are used to scrutinize the ways supply and demand for a security will affect changes in price, volume, and implied volatility. Technical analysis is often used to generate short-term trading signals from various charting tools, but can also help improve the evaluation of a security's strength or weakness relative to the broader market or one of its sectors. This information helps analysts improve their overall valuation estimate. Technical analysis can be used on any security with historical trading data. This includes stocks, futures, commodities, fixed income, currencies, and other securities. These concepts can be applied to any type of security. In fact, technical analysis is far more prevalent in commodities and forex markets where traders focus on short-term price movements. Technical analysis as we know it today was first introduced by Charles Dow and the Dow theory in the late 1800s. Several noteworthy researchers including William P. Hamilton, Robert Rhea, Edson Gould, and John McGee further contributed to Dow theory concepts, helping to form its basis. Nowadays, technical analysis has evolved to include hundreds of patterns and signals developed through years of research. Technical analysis operates from the assumption that past trading activity and price changes of a security can be valuable indicators of the security's future price movements when paired with appropriate investing or trading rules. Professional analysts often use technical analysis in conjunction with other forms of research. Retail traders may make decisions based solely on the price charts of a security and similar statistics. But practicing equity analysts rarely limit their research to fundamental or technical analysis alone. Technical analysis attempts to forecast the price movement of virtually any tradable instrument that is generally subject to forces of supply and demand, including stocks, bonds, futures, and currency pairs. In fact, some view technical analysis as simply the study of supply and demand forces as reflected in the market price movements of a security. Technical analysis most commonly applies to price changes, but some analysts track numbers other than just price, such as trading volume or open interest figures. Across the industry, there are hundreds of patterns and signals that have been developed by researchers to support technical analysis trading. Technical analysts have also developed numerous types of trading systems to help them forecast and trade on price movements. Some indicators are focused primarily on identifying the current market trend, including support and resistance areas, while others are focused on determining the strength of a trend and the likelihood of its continuation. Commonly used technical indicators and charting patterns include trend lines, channels, moving averages, and momentum indicators. In general, technical analysts look at the following broad types of indicators: price trends, chart patterns, volume and momentum indicators, oscillators, moving averages, support and resistance levels. Charles Dow released a series of editorials discussing technical analysis theory. His writings included two basic assumptions that have continued to form the framework for technical analysis trading. 1. Markets are efficient with values representing factors that influence a security's price, but 2. Even random market price movements appear to move in identifiable patterns and trends that tend to repeat over time. Today, the field of technical analysis builds on Dow's work. Professional analysts typically accept three general assumptions for the discipline. 1. The market discounts everything. Technical analysts believe that everything from a company's fundamentals to broad market factors to market psychology is already priced into the stock. This point of view is congruent with the efficient markets hypothesis, EMH, which assumes a similar conclusion about prices. The only thing remaining is the analysis of price movements, which technical analysts view as the product of supply and demand for a particular stock in the market. 2. Price moves in trends. Technical analysts expect that prices, even in random market movements, will exhibit trends regardless of the time frame being observed. In other words, a stock price is more likely to continue a past trend than move erratically. Most technical trading strategies are based on this assumption. 3. History tends to repeat itself. Technical analysts believe that history tends to repeat itself. The repetitive nature of price movements is often attributed to market psychology, which tends to be very predictable based on emotions like fear or excitement. Technical analysis uses chart patterns to analyze these emotions and subsequent market movements to understand trends. While many forms of technical analysis have been used for more than 100 years, they are still believed to be relevant because they illustrate patterns in price movements that often repeat themselves. Fundamental analysis and technical analysis, the major schools of thought when it comes to approaching the markets, are at opposite ends of the spectrum. Both methods are used for researching and forecasting future trends in stock prices, and like any investment strategy or philosophy, both have their advocates and adversaries. Fundamental analysis is a method of evaluating securities by attempting to measure the intrinsic value of a stock. Fundamental analysts study everything from the overall economy and industry conditions to the financial condition and management of companies. Earnings, expenses, assets, and liabilities are all important characteristics to fundamental analysts. Technical analysis differs from fundamental analysis in that the stock's price and volume are the only inputs. The core assumption is that all known fundamentals are factored into price. Thus, there is no need to pay close attention to them. Technical analysts do not attempt to measure a security's intrinsic value, but instead, use stock charts to identify patterns and trends that suggest what a stock will do in the future. Some analysts and academic researchers expect that the EMH demonstrates why they shouldn't expect any actionable information to be contained in historical price and volume data. However, by the same reasoning, neither should business fundamentals provide any actionable information. These points of view are known as the weak form and semi-strong form of the EMH. Another criticism of technical analysis is that history does not repeat itself exactly, so price pattern study is of dubious importance and can be ignored. Prices seem to be better modeled by assuming a random walk. A third criticism of technical analysis is that it works in some cases but only because it constitutes a self-fulfilling prophecy. For example, many technical traders will place a stop-loss order below the 200-day moving average of a certain company. If a large number of traders have done so and the stock reaches this price, there will be a large number of sell orders, which will push the stock down, confirming the movement traders anticipated. Then, other traders will see the price decrease and also sell their positions, reinforcing the strength of the trend. This short-term selling pressure can be considered self-fulfilling, but it will have little bearing on where the asset's price will be weeks or months from now. In sum, if enough people use the same signals, they could cause the movement foretold by the signal, but over the long run, this sole group of traders cannot drive price. How is technical analysis used? Technical analysis attempts to forecast the price movement of virtually any tradable instrument that is generally subject to forces of supply and demand, including stocks, bonds, futures, and currency pairs. Across the industry, there are hundreds of patterns and signals that have been developed by researchers to support technical analysis trading. Technical analysts have also developed numerous types of trading systems to help them forecast and trade on price movement. Technical analysis can be as complex or as simple as you want it. The example illustrates some basic principles of chart analysis. Since we are interested in buying stocks, the focus will be on spotting bullish situations in this chart. The first step is to identify the overall trend. This can be accomplished with trend lines, moving averages, or peak-trough analysis. For example, the trend is up as long as price remains above its upward sloping trend line or a certain moving average. Similarly, the trend is up as long as higher troughs form on each pullback and higher highs form on each advance. Areas of congestion and previous lows below the current price mark the support levels. A break below support would be considered bearish and detrimental to the overall trend. Areas of congestion and previous highs above the current price mark the resistance levels. A break above resistance would be considered bullish and positive for the overall trend. Momentum is usually measured with an oscillator such as MACD. If MACD is above its 9-day EMA, exponential moving average, or positive, then momentum will be considered bullish, or at least improving. For stocks and indices with volume figures available, an indicator that uses volume is used to measure buying or selling pressure. When check-in money flow is above zero, buying pressure is dominant. Selling pressure is dominant when it is below zero. The final step is to synthesize the analysis to ascertain the following: strength of the current trend, maturity or stage of the current trend, reward to risk ratio of a new position, potential entry levels for a new long position. While the example analyzed the chart for an individual stock, many of these techniques can be applied to charts for sector or broad market indexes as well. Technical analysis is applicable to securities where the price is only influenced by the forces of supply and demand. Technical analysis does not work well when other forces can influence the price of the security. In order to be successful, technical analysis makes three key assumptions about the securities that are being analyzed. The first key assumption is high liquidity. Liquidity is essentially volume. Heavily traded stocks allow investors to trade quickly and easily, without dramatically changing the price of the stock. Thinly traded stocks are more difficult to trade, because there aren't many buyers or sellers at any given time, so buyers and sellers may have to change their desired price considerably in order to make a trade. In addition, low liquidity stocks are often very low priced, sometimes less than a penny per share, which means that their prices can be more easily manipulated by individual investors. These outside forces acting on thinly traded stocks make them unsuitable for technical analysis. The second key assumption is no artificial price changes. Splits, dividends, and distributions are the most common culprits for artificial price changes. Though there is no difference in the value of the investment, artificial price changes can dramatically affect the price chart and make technical analysis difficult to apply. This kind of price influence from outside sources can be easily addressed by adjusting the historical data prior to the price change. The third key assumption is no extreme news. Technical analysis cannot predict extreme events, including business events such as a company's CEO dying unexpectedly, and political events such as a terrorist act. When the forces of extreme news are influencing the price, technicians have to wait patiently until the chart settles down and starts to reflect that new normal that results from such news. It is important to determine whether or not a security meets these three requirements before applying technical analysis. That's not to say that analysis of any stock whose price is influenced by one of these outside forces is useless, but it will affect the accuracy of that analysis. Many technicians employ a top-down approach to technical analysis, starting with broad-based macro analysis and ending with a more focused micro perspective. Broad market analysis using major indices such as the S&P 500, Dow Industrials, NASDAQ and NYSE Composite. Sector analysis to identify the strongest and weakest groups within the broader market. Individual stock analysis to identify the strongest and weakest stocks within select groups. For each segment, market, sector, and stock, an investor would analyze long-term and short-term charts to find those that meet specific criteria. Analysis will first consider the market in general, perhaps the S&P 500. If the broader market were considered to be in bullish mode, analysis would proceed to a selection of sector charts. Those sectors that show the most promise would be singled out for individual stock analysis. Once the sector list is narrowed to 3 to 4 industry groups, individual stock selection can begin. With a selection of 10 to 20 stock charts from each industry, a selection of 3 to 4 of the most promising stocks in each group can be made. How many stocks or industry groups make the final cut will depend on the strictness of the criteria set forth. Under this scenario, we would be left with 9 to 12 stocks from which to choose. These stocks could even be broken down further to find the 3 to 4 that are the strongest of the strong. If the objective is to predict the future price, then it makes sense to focus on price movements. Price movements usually precede fundamental developments. By focusing on price action, technicians are automatically focusing on the future. The market is thought of as a leading indicator and generally leads the economy by 6 to 9 months. To keep pace with the market, it makes sense to look directly at the price movements. More often than not, change is a subtle beast, even though the market is prone to sudden knee-jerk reactions. Hints usually develop before significant moves. A technician will refer to periods of accumulation as evidence of an impending advance and periods of distribution as evidence of an impending decline. Many technicians use the open, high, low and close when analyzing the price action of a security. There is information to be gleaned from each bit of information, separately. These will not be able to tell much. However, taken together, the open, high, low and close reflect forces of supply and demand. By looking at price action over an extended period of time, we can see the battle between supply and demand unfold. In its most basic form, higher prices reflect increased demand and lower prices reflect increased supply.